Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamilton here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Sandy, let's kick things off by discussing the Bank of Canada's upcoming decision on its lending rate. There's a lot of anticipation surrounding this announcement set for January 29th. TD economist James Orlando has shared some insights on this.
Absolutely, Steve. It seems Canadians are quite eager to see if the Bank of Canada will continue its trend from 2024, where we saw a spree of rate cuts. Orlando is suggesting a cut of 25 basis points this time, which is less aggressive than the 50 basis points cut we saw in December 2024. This would bring the overnight lending rate down to 3.00%.
That's right, Sandy. And it's important to note that these cuts can make borrowing cheaper for Canadians. With the current rate at 3.25%, a reduction to 3.00% could ease some financial pressure, especially for those with variable rate mortgages. More of their payments could go toward the principal rather than interest.
For sure, Steve. But it's not just about reducing rates. Orlando mentions that the economy is showing signs of resilience, with increased consumer spending and a strong job report showing 91,000 jobs added in December 2024. This suggests that the economy might not need as drastic a cut as before.
Indeed, Sandy. However, if the Bank of Canada decides to hold its rate, it wouldn't change much for Canadians immediately. Orlando notes that the current resilience might justify a rate hold. The central bank could choose to make this decision either in January or at the next meeting in March.
And let's not forget the external factors at play here, Steve. The U.S. presidential inauguration is happening just 9 days before the announcement, and there are concerns about potential tariffs from President-elect Donald Trump. These could impact Canada's economy significantly.
That's a crucial point, Sandy. If these tariffs come into play, the Bank of Canada might consider a rate cut as a form of insurance to support economic growth. Plus, we'll have the December 2024 inflation report from Statistics Canada released on January 21st, which could also influence the decision.
Orlando seems optimistic about inflation, noting it has stabilized around the bank's 2% target. If this holds true, it shouldn't heavily factor into the rate decision. However, Orlando forecasts a total cut of 100 basis points by the end of 2025, potentially bringing the rate down to 2%.
Exactly, Sandy. With the rates currently not exerting as much pressure as when they were at 5%, a reduction to around 2% might be where the bank aims to settle by the end of the year. It'll be interesting to see how these factors play out in the upcoming announcement.
So, Steve, let's dive into the details of Canada's 2025 federal budget. This is the first budget under Prime Minister Mark Carney, and it seems to be receiving a cautious reception from economists. They agree that while there's a shift towards long-term investment, the benefits will take time to materialize. What are your thoughts on this?
Well, Sandy, it looks like the budget is setting a foundation for future growth, but it's important to manage expectations. Economists are projecting economic growth of just 1.1% in 2025 and 1.2% in 2026. The unemployment rate is expected to remain around 7% this year and only gradually decrease to 6% by 2029. These numbers show a slow recovery, but they aren't far off from previous downturns.
That's true, Steve. Avery Schenfeld and his colleagues at CIBC Capital Markets pointed out that the projected federal deficits are not out of line with past periods of economic weakness. They're saying the challenge will be in executing these plans, especially in getting funds into large capital projects and housing developments. It's a bit of a wait-and-see situation, wouldn't you agree?
Absolutely, Sandy. The CIBC team highlighted that financing the deficits is not the main issue, but rather how effectively the government can get the money out the door to stimulate growth. They did warn that the $60 billion in cuts to federal services over 5 years could offset the benefits of new spending. So, patience is key here, as the real impacts on growth might take time to show.
And speaking of patience, Desjardins chief economist Jimmy Jean also noted that the budget reflects a reluctance to fully commit to investing in Canada. While the budget is headed in the right direction, the planned spending cuts fell short of expectations. However, they're confident that Canada's AAA credit rating is safe.
Right, Sandy. And it's interesting to see that Scotiabank analysts view the budget as a constructive step for long-term productivity given the $280 billion in planned capital spending over 5 years. They're optimistic about the opportunities for real asset and technology-focused investments, but execution risks, like project delays and bureaucratic challenges, are still concerns.
So, Steve, what does this mean for the mortgage and housing sectors? The government's focus on infrastructure, supply chain renewal, and housing developments is promising, but the industry shouldn't expect immediate relief. Historically, these initiatives take years to impact mortgage rates and housing affordability.
That's right, Sandy. Stakeholders in the housing market need to be patient as well. The improvements in infrastructure and capital assets will eventually benefit the economy, but it won't happen overnight. It's a long game, and everyone involved will need to keep an eye on how these plans unfold over time.
Let's jump into the topic of the missing middle housing in Canada. According to a recent report from the Canada Mortgage and Housing Corporation, or CMHC, there's been a notable increase in the construction of these housing types, which include row houses, stacked townhomes, and low-rise apartments. These are gaining traction as they offer more space than a typical condominium and are often more affordable than single detached homes.
That's right, Sandy. The report highlights that between 2023 and 2024, the construction of missing middle housing rose by 44% across 6 major Canadian cities. This is a significant jump from the 5% increase seen from 2018 to 2023. It seems that this type of housing is starting to fill a crucial gap in the market.
Absolutely, Steve. The idea here is to broaden housing choices for families who find high-rise apartments too cramped but can't afford detached homes. This type of housing can be built in existing neighborhoods, which often makes it faster and less costly to develop.
And it seems Calgary and Edmonton are leading the pack. They account for 67% of missing middle housing starts. Both cities have conducive traits like plenty of land and supportive regulations, which have spurred this growth. Plus, with a rising population due to interprovincial migration, there's increased demand for these units.
Yes, and CMHC notes that favorable policies and incentives in these cities have further facilitated this development. In the prairies, row home construction in the suburbs contributes significantly to the missing middle supply, especially around Calgary and Edmonton. There's even more infill construction happening downtown.
Meanwhile, Ottawa and Montreal are also making strides, accounting for 21% of the total missing middle construction in 2024. The rise in interest rates in 2022 pushed developers towards smaller projects that need less capital and are easier to finance, which has helped cushion the downturn in overall development activity.
Interestingly, in Ottawa, row homes dominate due to the availability of land and favorable zoning bylaws. In Montreal, apartments of 4 stories or less have been the most built among missing middle housing types since 2018, and CMHC expects this trend to continue.
However, Toronto and Vancouver are lagging behind. In Vancouver, the construction of missing middle housing fell by 56% from 2018 to 2024. Developers cite the high cost of land, especially downtown, as a barrier to building these lower density homes.
Toronto, on the other hand, is starting to catch up. Low-density infill conversions have increased fourfold in the first half of 2025 compared to single and semi-detached starts. These projects are adding density to neighborhoods that were previously limited to single and semi-detached homes.
It's clear that while some cities are making strides in solving the missing middle puzzle, others still face significant challenges. But overall, the increased focus on this type of housing could play a crucial role in addressing Canada's housing crisis, especially as demand continues to grow.
Steve, let's discuss the recent adjustments in Ontario's home building projections. It seems the province is facing some challenges in meeting its ambitious target of constructing 1.5 million homes over the next decade. The latest fall economic statement has revised these projections downward again. What does this mean for the housing market?
Sandy, it's clear that Ontario is grappling with some significant hurdles. The target of 1.5 million homes has been described as a soft target by Finance Minister Peter Bethlenfalvy, which suggests some flexibility in their approach. The focus seems to have shifted towards building as many homes as possible rather than strictly adhering to the original goal.
That's right, Steve. And with the projection for this year now at 64,300 homes, it's even further from the pace needed to hit that 1.5 million mark. The figures for the coming years don't look much better either. In 2026, they're expecting about 70,200 new homes and then a gradual increase to 83,700 by 2028. It seems like a slow climb.
Yes, and according to the fall economic statement, there are several factors at play here. Private sector forecasters have pointed out the negative effects of tariff-related uncertainty and rising material costs on home building. This has put additional pressure on the industry, making it harder to ramp up construction to the desired levels.
Indeed, and it appears that the government is trying to address some of these issues. For instance, they're proposing an HST rebate for first-time homebuyers on homes valued at up to $1 million. However, critics argue that this may not significantly benefit buyers in high-cost areas like the Greater Toronto Area.
That's a fair point, Sandy. The rebate is expected to cost $35 million initially, but it will rise to $190 million and then $245 million over the next 2 years. While it's a step in the right direction, it might not be enough to spur a major increase in home construction, especially when considering the broader economic challenges.
And let's not overlook the impact on the labor market. NDP leader Merritt Stiles has expressed concern that the government seems to be backing away from its housing commitments, which could leave many construction workers without jobs during a housing crisis. It's a tough situation that requires careful navigation.
Absolutely, Sandy. While some might see the government's approach as throwing in the towel, it's also about being realistic with the current economic and market conditions. The slowdown in condominium construction, for example, has been somewhat offset by an increase in purpose-built rental projects, which shows some adaptability in the market.
That's true, Steve. And although Ontario home resales are projected to decline by 8% this year due to economic uncertainty, there's a forecasted rebound of 10.2% next year. It's a mixed bag of challenges and potential opportunities that the province will need to balance.
The situation is indeed complex, Sandy. With land transfer tax revenue projections taking a hit, down $576 million from the spring budget, the financial implications are significant. It's going to be essential for the government to keep exploring ways to stimulate home building while managing these economic pressures.
Steve, let's delve into Ontario's home building projections, which have recently been adjusted in the fall economic statement. The province seems to be facing quite a few challenges in meeting its ambitious goal of building 1.5 million homes over the next decade.
That's right, Sandy. The government's original goal has now been termed a soft target, indicating some flexibility in their approach. Finance Minister Peter Bethlenfalvy and Municipal Affairs and Housing Minister Rob Flack have both acknowledged the difficulty in reaching this target.
And with the projections for this year now at 64,300 homes, it's clear that we're falling short of the pace needed to meet that 1.5 million mark. The numbers for the coming years aren't too promising either, with expectations of 70,200 new homes next year and a gradual increase to 83,700 by 2028.
Yes, and the fall economic statement highlights several factors contributing to these lower projections. Private sector forecasters have pointed out the negative effects of tariff-related uncertainty and rising material costs on home building. These issues are adding pressure on the industry.
It's a tough situation, Steve. The slowdown in condominium construction, for instance, has been partially offset by an increase in purpose-built rental projects. But it seems like the province is still struggling to ramp up construction to the desired levels.
Absolutely, Sandy. And while the government is proposing an HST rebate for first-time homebuyers on homes valued at up to $1 million, critics argue that this may not significantly benefit buyers in high-cost areas like the Greater Toronto Area.
That's a valid point, Steve. The rebate is expected to cost $35 million initially, but it will rise to $190 million and then $245 million over the next 2 years. It's a step in the right direction, but perhaps not enough to spur a significant increase in home construction given the broader economic challenges.
And let's not overlook the concerns raised by NDP leader Marit Stiles, who expressed worry that the government seems to be backing away from its housing commitments. She highlighted that many construction workers might be left without jobs during this housing crisis.
Indeed, Steve. It's a complex issue that requires careful navigation. While some might see the government's approach as conceding defeat, it's also about being realistic with the current economic and market conditions. The adaptability in the market, such as this shift towards purpose-built rentals, shows some promise.
True, Sandy. And although Ontario home resales are projected to decline by 8% this year due to economic uncertainty, there's a forecasted rebound of 10.2% next year. It's a mixed bag of challenges and potential opportunities that the province will need to balance.
The financial implications are significant, Steve, with land transfer tax revenue projections taking a hit, down $576 million from the spring budget. It's going to be essential for the government to keep exploring ways to stimulate home building while managing these economic pressures. Steve, let's delve into the latest data on Durham home prices, which have now dropped a significant 30.7% from their peak in February 2022. This is part of a broader trend where suburban areas like Peel and Halton are seeing even steeper declines than the Toronto region average.
That's right, Sandy. The Toronto Regional Real Estate Board's October report highlights these changes. While the average home price in the Toronto area is down 21% from the peak, Durham's drop is more pronounced. This reflects the rapid price increases these areas saw during the pandemic.
Exactly, Steve. Sean Ziegelstein, a broker at Royal LePage Your Community, pointed out that these suburban areas experienced some of the largest jumps when the market took off during the pandemic. It was an unsustainable growth, and now we're seeing the market correct itself.
And the correction is evident in the sales numbers, too. In Durham, sales are down 19.5% since last October, and properties are taking 4 times longer to sell compared to October 2022. It's a clear sign of the cooling market.
Yes, and it's interesting to note that lower-priced homes are moving faster. Ziegelstein has been tracking this trend, and it seems that homes priced under $1 million are spending less time on the market. It's a more affordable entry point for buyers.
Jason Mercer, the TRREB's Chief Information Officer, mentioned that for buyers looking to enter the market now, this situation could be beneficial. With prices more affordable, it's a good time to buy, especially if you're looking at the long term.
However, there are still uncertainties. Mercer also noted that sectors affected by tariffs and potential return-to-office trends could impact the market further. More people might choose to live closer to work in downtown Toronto if remote work policies change.
That's a valid point, Sandy. The dynamic nature of the market means that external factors like these could cause shifts. It's essential for buyers and sellers to stay informed about these trends.
And looking at specific areas, Oshawa has seen one of the steepest declines in sales, dropping nearly 25% compared to last year. Meanwhile, Mississauga's detached home prices have fallen 29% since the peak in 2022, despite an increase in new listings.
It's a mixed picture across the Greater Toronto area. While some areas are seeing price drops, others like Markham have seen a slight increase in average prices compared to last year. It highlights the varied impacts across different regions.
Ultimately, it's a complex market with both challenges and opportunities. For those looking to buy, it might be an opportune time to enter the market. but they'll need to be cautious and consider long-term trends and potential changes in the economic landscape.
Absolutely, Sandy. As always, staying informed and understanding your financial situation is key to making the best decisions in such a fluctuating market.
Let's dive into the current landscape of mortgage rates in Canada, Steve. It seems like there's been a shift in expectations regarding the Bank of Canada's upcoming interest rate decision. Initially, many anticipated a cut, but now the odds are leaning heavily towards the bank holding steady.
That's right, Sandy. According to data from LSEG, there's about a 90% chance that the Bank of Canada will maintain its current rate in its December 10th announcement. This is despite some earlier expectations for a cut, which shows how quickly economic indicators can shift perspectives.
Exactly, Steve. It's a reminder of how fluid the economic landscape can be. Daniel Viner, the principal broker at DV Capital Corp, emphasizes the importance for those shopping for variable rate mortgages to secure a rate hold on their current offers. Even if the Bank of Canada keeps its rate steady, changes in the bank's prime rates and discounts can affect what borrowers end up paying.
Absolutely, Sandy. Viner also suggests that borrowers should regularly check in with their broker before closing to see if they can negotiate a better discount on their provider's prime rate. It's about being proactive and ensuring you're getting the best possible deal.
And that's crucial, especially with the uncertainty in the market. As Viner points out, even if the central bank's rates stay the same, the discounts offered by mortgage providers can fluctuate, and it pays to shop around.
Indeed, Sandy. It's also important to consider the broader economic context, like potential shifts in trade policies or economic reports that could influence future rate decisions. While the current outlook suggests stability, there's always room for unexpected changes.
Right, Steve. And speaking of unexpected changes, the market for fixed mortgage rates has also seen some movement. After months of stagnancy, there has been a drop in fixed rates, which could be appealing for those looking for stability in their mortgage payments.
That's an interesting point, Sandy. Fixed rates offer predictability, which can be a significant advantage for those who want to lock in their mortgage payments over a set term. With the recent drops, it might be a good time for borrowers to consider this option.
Absolutely, Steve. It's all about weighing the options and considering what fits best with one's financial situation and long-term goals. Whether it's a fixed or variable rate, the key is to stay informed and proactive in managing your mortgage.
Exactly, Sandy. And for our listeners, it's important to keep an eye on these trends and consult with professionals to make well-informed decisions. The mortgage market can be complex, but with the right guidance, you can navigate it successfully.
Let's wrap up today's episode by discussing the impressive third quarter results from Dominion Lending Centers, Inc., also known as the DLC Group. They're one of Canada's leading franchisors of mortgage professionals, and they've reported a notable 19% growth in funded mortgage volume, reaching $23.5 billion for the quarter.
That's a significant achievement, Sandy. This growth is accompanied by a 20% increase in revenue, reaching $26.4 million compared to the same quarter last year. It's clear that DLC Group is capitalizing on the improving activity levels in the housing market and the ongoing strength in the mortgage renewal sector.
Absolutely, Steve. It's interesting to note that their adjusted EBITDA increased by 16%, reaching $14.2 million, and their net income saw a substantial 70% rise to $9 million. This shows their strategic initiatives, like the adoption of their Velocity platform, are paying off.
The adoption rate of Velocity, their integrated operating platform, is particularly impressive. It increased to 85% from 73% in the same quarter last year. This platform is designed to streamline the mortgage process, and its increased use among brokers is likely a key contributor to their success.
And it's worth mentioning the broader context, Steve. While DLC Group has shown strong results, Gary Morris, their chairman and CEO, acknowledges the tougher comparison quarters ahead, given the strong growth from last year. Yet, their focus remains on growth and profitability.
Indeed, Sandy. It's important for businesses to maintain a balance between growth and sustainability. The DLC Group's strategy of leveraging technology to enhance broker productivity and expand their market reach appears to be a solid approach.
And with the challenges in the Canadian housing market, having a robust strategy is crucial. The DLC Group's emphasis on productivity and customer engagement, highlighted at their recent sales conference, suggests they're well prepared to navigate these challenges.
Absolutely, Sandy. It's all about adaptability and staying ahead of market trends. With their strong network and innovative tools, DLC Group is well positioned to continue their growth trajectory.
As we conclude today's episode, it's clear that the mortgage and real estate sectors are continuously evolving. Staying informed and adaptable is key, and that's what we aim to provide here on the Ontario Mortgage and Real Estate Insights podcast.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Janine reads, outro message, verbatim. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.